This is a position I'm currently still in. It's not a gigantic position, but it's a good example. So Norwegian Cruise Lines, right? This is one we alerted on at the beginning of the month with the cruise line break. And this would be an example of the 3-2-2 strategy. Also, you could call it the quarterly universe with the quarterly signals. And I bought it and then I added to it and then I added to it. So right here above 2044, that was when I bought it because it triggered the 2-2 reversal quarter. There's a simultaneous break in the cruise lines because not only did that do it, but CCL also went reversal quarter and Royal Caribbean went 3-2 quarter. So they simultaneously broke scenario 2 to the upside at the same time. So the way you do that is you buy it, and then depending on your risk, you're either risking the low of the daily, the low of the week, or you could say like a monthly reversal against or the low of the month. And we put that there because if it stops us out, we can always get back in. So if it didn't work, I would have lost like maybe 5% or something, or maybe even less, maybe a couple percent, right? Because these are 9/19, so they're 2 months out. So that break occurred. When this continued on Wednesday, we could have added to it because it reconfirmed, or we could just decide to hold. Cost basis is right around here. So once it's gone up, we put our stops to even because we don't want to let winners go red. Then we look for additional signals. So you'll see we had inside day 3-1 in the cruise lines here. When this broke 2 up, I had already gotten a winning position and the position was up 7% on the stock. Therefore, when this broke, I could risk adding more here using the low of this bar as a stop. Because what the equilibrium tells you is they agree on price, and then if it's a 2 to the upside, it's expanding to the upside. Then we went 2 on the day today, and I could have either added or just held. I think I added like 1 contract to it. So a small add to it today just because it's continuing. So as long as this goes higher lows on the day, I'm willing to trail stops up. And if it reverses, I can either keep my stops around my cost basis, which my cost basis is probably closer to where this white line is right now. With options, it's a little iffy because of the Greeks and whatnot. I can either keep my stops here and let the quarter play out, or I can trail my stops up on the day. But that was a position we created here. MGM is another one. So in MGM, this is another 2-2 reversal strategy on the quarter. You'll see the lower low paired with the 2-2 signal back through a previous range. So that's what we look for. So same thing. When this broke, I just bought it. And my stops at the bottom of the quarter here, I did not add to this. And it's currently up 28%. So these are like some, entry positions to start the quarter. Since we still have 2 months and 21 days left, we don't need a lot of money to make a lot. All right, if MGM goes all the way up here, another $13, trading, let's say 51, I would make $14 a contract. So that'd be $56. And then for each dollar it went up, I make 100. So with a position of less than $1,000, this would be a $5,600 position just on a small options position. But the goal then is what we want to look for is ways to add to that. So I did add to this one. Actually, I think I did add to this one. Yeah, I did. So we had the gap down buy, which would have been the ideal add. And I think I did get in there on the gap down buy. It could have been in here or on the 2-2 day. Both of them are the same though. So on the gap down buy, same thing. If my entry's here and this goes gap down buy in green, it's like called a gap down buy strategy. And we can buy that as long as the day is green, we can put our stop here. Because if it's going to continue, it'll take this out and we'll just exit the whole position. If it's going to reverse back up, we can add to it again and then continue to trail our stops up on the daily basis all the way up into here. So my cost basis is likely to be closer to, where this white line is. I can either trail my stops up or keep my stop even to where I got the position. And so at the moment, it costed $900 and it's trading just around $1,200 for the whole position. And that's another way to do it. So you can see it's relatively simple with these quarterlies and dailies. Now, this is for me because I'm here pretty much every day. Even on Mondays, if I'm not streaming, I'm checking my positions every day. And all I'm doing is, did it continue or did it reverse? So if this reverses tomorrow, I'll reduce it. If I have 4 contracts, maybe after it reverses, I'll take 2 off. Same thing with everything. So those are some positions just from right now. If we go to VLO, this is another one. So VLO took the quarter up. I did not get the initial quarterly break. However, we identified the simultaneous break in energies on Tuesday. So when this broke, it was already going a little bit. I bought it and I put my stop at the low of the day, because if it continues, I want to be in there because it's a quarterly simultaneous break. And then it goes in favor of my position. So I get to just hold. It did tick down slightly. However, you'll see it's 4 cents below yesterday's lows. That's not something I have to be scared of, right? Now, if we're trailing stops up, that could have got you out. However, when it comes back the other way and goes green, like we said, we don't have to get out of this. It's holding strong, whereas the rest of the energies were pretty red on the day in the morning. So when that goes green here, we actually could have bought more for the 3 to the upside. And the way you do that is you use the hammer outside bar strategy. 3-2, you can buy that, and your stop would go at the low of this bar. Maybe it stops you out once, and then you get back in, and then it goes. Or maybe it goes red, and then it goes green, and then you're in, stop here, and it goes. So be it. Right? But this is how we want to think about it. And then, depending on the time frame and what your plan is, if this was my entry, I'd like to trail that up and then reduce it. So if I buy 2 more contracts here, I'd reduce one of those here. Because then, even if it comes back to where I got it, I have a winner. So the goal is always just, can we create a winning position, then move stops towards price? And this is all using the quarterly reversals as our strategy. Another strategy we can employ, like we mentioned this morning on the airlines, is what we call a gapper, red to green. So you can see it goes red first in United. When it gaps up, we cannot buy it right away because it's unlikely to work out. But if it goes red first, then we have signals going back to the upside. So if we were really fast in here, this inside fiver right here, boom, you're in, and then you can hold that position the rest of the day because you got news, you got a gapper, you got a kicking pattern, you got everything you need. But the red to green move, when it goes green on the day, we can buy it, then just have a tight stop. Maybe it's 30 cents, maybe it's low. I wouldn't put it at the lows. That's a little bit far. That's 3%. Like 20, 30 cents. It should just go right away if we're right. So that's another way we can trade things. If we go to let's think, uranium. This one is what we call broadening expansion. So if we go on the month, once we're up and out of a broadening formation, we expect price to continue in that direction as long as we have full time frame continuity. At this point, it's inside month, which means it's not going down, right? We're making higher lows still, so it's not going down. It's also not going up, but we're outside the broadening formation. So what we'd like to see is, can we make higher lows and then higher highs to keep it going? Maybe it takes a month to set up. We'll see. But once we got above 34.47, the top of this broadening formation, I was able to just buy it and say, that's my level, right? 34.47, 34.50, right around there. And give it a little bit of time. This is a shares position, so I'm risking less money because it's not options, and I'm less, stuck into like the time aspect. Like it has to go now. So I can get a small position here, right? You can see it retests, then they go. And now it's nowhere near where I got it. So when this reclaims, you see with a 3, going into the rest of this week, you see like a 2-day chart, maybe we get a reversal here after a lower low. This would be that 2-2 reversal strategy. I could buy it and then trail my stops up, see if they get going again. So you can start small and then add to positions. That's the main thing we want to be doing. Because if you go in there and you, beginning of the quarter, first day of the quarter, you buy $10,000 into a stock and then it reverses, now you're in a problem because you just lost a lot of money and it's the first day of the quarter, right? You still have 2 months, 29 days for the rest of the quarter to play out. So if you do that, you're putting a lot of money in something we don't know if it's really going to go or not. We just know we have a signal. And when you stop out of it, you have no other positions. So what we want to do is we want to diversify at the beginning when it's more uncertain. So like simultaneous break and cruise lines, buy all 3 of them, right? Then if the cruise line reverses against you, get out. If it continues, hold or add. And if there's new signals, add. And that's what we want to do. So it's like you open a position, reverses against, get out, let's say your other position you opened goes inside bar signal and then it continues, add to that one, then trail the stops up. Then let's say you get another signal there, add to it again, trail the stops up, and then it keeps going. So you keep your losers small because it's your smallest position, and then your winners really, really big because you're adding and holding. And that's why we say you don't need a lot to make a lot. Like, let's say we're really right in MGM. If we're really right, we know it's going up there. So like we said, $900 position could be a $6,000 trade here just on the quarterly. And that's a pretty good trade. Right? I'd be happy about that. And if I can double that position, let's say it gets to 45 and I grab some like 47.5 calls, maybe I double the amount I make in there, or maybe triple, right? Depending on how much I want to risk. And that's the other thing. When you add to trades, you're risking their money. If you enter really big positions at the beginning, you're risking your money. So if you enter a trade and you're like, I'm risking $1,000, it's like, that's your money. But if you enter a trade, make 500, triple your position size, risking that $500, you're risking their money because you made the winning trade. You had the losers against you. You won, took their money. You add to it, risking their money. And then the ones you add to tend to just keep going further. The ones that don't keep going, you risked their money. So you made 500. Let's say you lost. You gave 400 back. You made $100. Cool. Next one. You make 600. Take a loss on your ad. You make $50. Cool. Next one. You make $700. I need to close it, Alex. I need to close it. No, don't close it. It's still good. New signal sets up. You add to it, risking the $600, which could be 4 times your position size. Who knows? Then it keeps going, and now you make 10 grand. And you only risked $600 of their money and maybe $100, $200 of your own. So you're risking $200. When you add to it, you make like 6,000 and you're risking theirs. So you risk 200 to make 6,000. That's a really good trade. So we want to think in terms of where are they actually buying or selling? Can I create a winning trade there, risking some of my money? Then am I able to add to that, risking their money?